All right, let's get started. I want to thank FX Street for this opportunity to share some time with you. My name is John O'Donnell. I'm the Chief Knowledge Officer of Online Trading Academy. That means I do a lot of the research. If any of you want to contact me, my email address is john@tradingacademy.com, and or go to my website. We have lots of free newsletter. We publish 4 times a week. And we have lots of free webinars there, and of course we've got 25 offices to serve our clients all across the world, and you'll see the locations tab there. I'm going to talk today about how to profit in today's Globalization 3.0 credit bubble. And the credit bubble, the access to credit, remember credit is denominated in a currency, depending upon the central bank of origin. But credit is a very important consideration, and it's been a very important consideration in this dollar rally, and I want to talk a little bit about it today from a little different perspective than maybe what you've seen. First of all, human emotions impact our collective actions. This is also known, a term coined by Robert Prechter, as socioeconomics. Socioeconomics is a study of change of social mood, and the premise is pretty straightforward. That is, how you and I feel impacts our human action. And this human action is distilled in these markets of our buying and selling patterns. Now take a look at this curve on the screen. Which do you believe is the most challenging of human emotions that you go through, or you and I go through on a daily basis as we make buying and selling decisions in our life? Which one do you think has the biggest challenge? Now, we've served over 10,000 clients, and virtually they all come to us in one of these states of mind. As a matter of fact, they have it going on depending upon with their multiple compartments of their life, their family, their business, even their children. They certainly come to the market is absolutely related to the stock market and the Forex market. And you're right, CVJ, it's denial. This, at the end of the day, my partner is from Israel, so we have a special saying around here, and that saying is this, is that denial is not just a river in Egypt. Denial means that, hey, dude, you're on the wrong side of the trade. Get out. And you need to have a plan. Now, I want to talk today about a very significant event that not many people are talking about, and it's going to have a big impact on the U.S. dollar and all currencies going forward. And it's a stock market. I don't know if you know this or not. This is the complimentary of our friends at Elliott Wave, but we have recently broken on June 19th a 34-year price trend in the Dow. Now look at this. This price trend goes all the way back to 1974, even through August of 82, and we can debate when the bull market started in the Dow, but we've recently broken a 34-year price trend. Now, will this support hold? Well, it hasn't held. We saw it tested at least 5 times this year, from January 08 through March, and now we're today back down to the 11,500 level on the Dow, and we have significantly broken this 34-year price trend, and we very well could have a precipitous decline in the Dow, the S&P, and Nasdaq, which is very deflationary, and it's going to have a big impact on the U.S. dollar, because the Dow, the S&P, and Nasdaq are denominated in U.S. dollars. And I'm going to talk about what I think that impact might look like. Now, let me give you some examples of what's happening in America, and I call it the Globalization 3.0 credit bubble. And what we are going through is a complete dead man walking phenomenon of the American banking industry. Now, the American banking industry is the biggest banking industry in the world, and we have lots of banks like Zions Bank Corp. Their equity has dropped from $75 a share down to $25 a share, and most of what you're going to see here is this tremendous dilution and recapitalization of the American banking industry, where banks are going out and issuing convertible preferred shares, which are diluting the common shareholders. So I think we're in the early stages of this recapitalization program. Key Corp stock has fallen from $40 a share to $11 a share. Their preferred's now trading at a 13% yield. Fifth Third Bank equities dropped from $60 a share to $14 a share, and they're probably going to have to raise some more capital. Washington Mutual's equities dropped from $40 a share to $3 a share, and they're going to have to go out and raise some new capital, as is National City. Regions Financials dropped from $40 a share to $8 a share. And we've even seen other financial institutions like GMAC, a component of General Motors. And General Motors, of course, as you all know, both General Motors and Ford have made a lot of their money in the past financing cars. Well, the next domino to drop in this global credit bubble is not going to be the subprime mortgages, we'll talk about a little bit later, but it's going to be in the area of commercial loans, it's going to be in the area of accounts receivable, credit card receivables, and automobile paper. And now we've seen General Motors drop precipitously from $80 a share to $10 a share. And what I think we're going to see happen is that these major financial institutions, including companies like Wachovia and Citibank, who've also seen precipitous declines in their common shares because they've had to go out and recapitalize their banks. And the way they're doing this is that universally they all have about the same model. They're going out to replenish their capital from this terrible real estate subprime mess. And the thesis of my talk today, and I'm going to give you some current data on this, is that what we've been going through in America since the summer of 2005 is now aggressively spanning to Western Europe, and that on a relative basis, the problems in countries like UK, Netherlands, and Spain, where they've got toxic paper issued out there in their real estate sector, it's 8 to 10 times worse as a percent of GDP than what it is in the United States. So basically, we have a bunch of financial institutions like Citibank, Merrill Lynch, Morgan Stanley, and others I have listed here that many consider too big to fail. And I'm here to tell you, ladies and gentlemen, I think we've seen the model that the Fed is going to do with these institutions, and it's probably going to look like what they did with Bear Stearns. They're going to engineer a merger with a stronger financial institution. Now, bank credit is precipitously declining. If this chart here is showing you from 1992 through 2008, this is bank credit plus commercial paper year-over-year percentage change. Now, this was the recession that we saw coming out after 9/11, where we had this precipitous decline. This is deflation. Deflation of bank credit is a very, very important component, and now we're starting to see the same phenomenon again, and I'm forecasting that we're going to see continued deflation in the banking sector, led by these real estate mortgages and other kinds of paper that are issued out there. People forget there's a social mood tied to a mortgage market, and we have two components of a mortgage market. That is a willing lender and a willing borrower. And take a look at this. The net percentage of commercial banks tightening lending standards are accelerating at an accelerated rate of change. We've seen it go from virtually in 2006 from virtually a 0% of banks tightening, where today it's in excess of anywhere from 40 to 60% of banks tightening, both in commercial real estate, credit cards, and mortgages. So we have a global credit bubble, and what's happening is the banks are in such a state of fear, driven by their social mood and the performance of their balance sheets, that they don't even want to lend to one another, much less to you or I to finance a new business. So we're going to see a tremendous amount of new information here. Now, will the credit bubble burst? Well, my position is yes. I believe we have seen a tremendous growth of the credit bubble. This showing you that the average was about 44%, and it's now grown to over 64%. And I think we're going to see that bank credit as a percent of GDP growing from 44% to over 64% is that we are in a global credit bubble. The probability is, in my mind, that the global credit bubble will burst, And as the global credit bubble bursts, we're going to experience a bout of deflation. Now, the number one investment you want to own in periods of deflation, which I believe we're going through already, is cash and cash equivalent. So I think your ability to learn to trade foreign currency is a very, very valuable resource. Key to let bank loans and leases. Well, we're starting to see non-current loans grow year over year change. And take a look at this. We've seen this tremendous growth in non-performing loans and leases. We've seen the banks that have total loans and leases that are 30 to 89% past due. And we're really starting to see this accelerated bubble phase that we have been talking about for some period of time. Banks are not making any money. Obviously, they have a real problem. And if they're not making any money, credit freezes up. And when credit freezes up, it's time for massive economic recession. Some would say possibility of even depression. FDIC commercial banks, as a percent of unprofitable institutions, you can see this back, the S&L crisis back here where we had over 20% of them. And today we're starting to see in this new credit crisis, we're ramping back up to those same levels. The normalized profits of banks, the actual profits of bank and the normalized corporate profits of banks all the way back through 1980 is starting to roll over, and we're starting to have a lot of pressure. This is going to cause the ability of S&P 500 operating earnings probably to become anemic because it's going to be more and more difficult to get capital through traditional leverage banking cycles. And this is what, since 2000, what we've seen is the year-over-year S&P 500 operating earnings growth. And as you can see, it's starting to become quite anemic at an accelerated rate of change. Certainly, this is where we are in 2008. This is where the forecasts look like for 2009. Okay? Now, part of our problem is this tremendous U.S. Treasury deficit, and it shows you when we used to have some surpluses going back in the blue and where we've deteriorated and how fast the deterioration is growing. According to the Congressional Budget Office, the federal government recorded an estimated deficit of $102 billion in July. That's about $65 billion more than it was a year ago. Each one of these bars represents about 1 month of time. So including this shortfall, the running total deficit over 12 months is about $374 billion. That happens to be a 3-year high. And if this continues to move along, the accumulated deficit for 12 months is going to break the record of $455 billion. We haven't seen that since April of 2004. Now let's talk about part of the problem is. The National Association of Realtors released its updated quarterly forecast through the middle of the year. Now, you obviously have to recognize that their economists are quite biased with a real estate buy and hold bias. But that taken into consideration, looking at their own data, they're starting to get a dose of reality here. In less than 12 months, according to the National Association of Realtors, home equity will be 1% higher than it is now. But over the same span, the pathologically bullish trade organization also expects sales of existing homes to explode by 33%. Now, this is their forecast. Now, I don't know where they can come up with these numbers. I'm amazed that they can even publish data like this. I don't know what neighborhood you're living in. But they're absolutely living in la-la land. So let me go forward here a little bit and talk about what our challenge is. I'm asked all the time, besides real estate, which I'll get into in a little bit more detail in a moment, what happened? Why did oil go up? Well, I think this chart talks very clearly about why oil went up. Number one, if you look at the world GDP growth since even 2002, in the red line here, you can see that world GDP was growing at a much faster rate than our oil production. if I'm using my baseline of 100, we've seen world GDP grow to the rate of 130, and we've seen oil production here at about a rate of 112 on relative output. Now, what we're finding is that there are some correlations. John Murphy's done a lot of work. I recommend John Murphy's books on these intermarket relationships between, in this particular case, the S&P 500, the CRB index, the U.S. dollar in green, and 30-year bond yields. And we've already seen the U.S. stock market peak. This peaked October 9th, right in here at 14,164 on the Dow. And right here is where we saw the peak in our July commodity-led equity rally. And this another peak right here again in July. I think we've seen a tremendous decline now in oil. We've seen oil go from $147 a barrel. Today it's back down to the 108 range. And we've seen gold precipitously decline from the 1,050 level, and today it's down in the vicinity of about $800 an ounce. And I believe we're going to see gold go down to the $700 level. I think we're going to see oil go back down, bust through this support at 115. We've already broken through it down to 108. And I think we're probably going to see oil in the reasonably short period of time with this global recession that I'm forecasting, that's in virtually every developed country and some undeveloped countries. I think we're going to see oil drift down to the $85 zone, somewhere between 85 and 95, and probably stay in a trading range. The bureaucrats were telling us how terrible the speculators were when they drove oil from roughly $85 to $147, and I don't hear any bureaucrats whining about the speculators today who've now driven it from 147 back down to 108. I'm bearish on gold. I'm bearish on all the metals, including base metals and precious metals right now. And the reason for that is we have a global recession. I mean, if you look at all the base metals, copper, zinc, lead, if you look at gold, silver, platinum, palladium, they're all under a lot of pressure. The whole CRB index is under significant pressure, and it's called demand destruction. At the end of the day, my father used to tell me, with his farm wisdom, that the cure for high prices is a high price. And that's exactly what happened. As oil went up, people started to become changing their pattern of consumption, and we've just got demand destruction taking place everywhere. This is a very interesting chart. This is from the Moore Research Center. This is gold's 34-year seasonal cycle. Now, here we are in September, right here in the beginning start of September. This is from 1974 through 2007. This is taking the 34-year pattern in turquoise and the 15-year pattern below it. And it's laying one over the other. And you can see that this seasonal pattern is forecasting a higher gold price through September, then a decline through October. I think we very well could, I think we need to pay attention to this because we've got a lot of data here that supports both the 15-year price pattern and the 30-year, 4-year price pattern. But I think with this global deflation that we're seeing right now, and that I think we're going to see a continued lower, and there'll be a series of rallies. It isn't going to go straight down. But I wouldn't doubt that we're probably going to see gold drift back down to maybe, $700 an ounce, maybe $650 an ounce before it starts to catch a lot of support. I'm looking, this is the seasonal pattern on crude oil. Again, this is the 25-year pattern laid over the 15-year pattern, and they're remarkably high correlation of incidence. This is from 1983 through 2007, and here we are in September. And look at this. If you look at September through December, the seasonal pattern is showing us over the last 25 years and 15-year pattern a high correlation of falling prices. And given the worldwide recession that we're in, this is part of my basis of seeing oil headed back to the $85 level and then stay in a relatively tight trading range. Here's some other seasonal patterns. Going back, the S&P 500 Energy Index, this is a 60-day percent change pattern going back from October of 2002 through July of 2008. And I don't see a tremendous amount of conviction here, but I thought I'd share this with you. I got this from Bloomberg and U.S. Global Research. I thought you might find that quite interesting. Let's take a look at oil production. We keep hearing about the peak oil theory, and I want to remind you, it is a theory. It's not the peak oil law, it's the peak oil theory, and we're going to have to let that play out and see where it evolves to. But OPEC's production peaks really back here in 1977, and the capacity in 1988 and spare capacity through 1985. But I'm showing you here that this is their peak all the way back, and I'm looking at crude oil production here in turquoise. I'm looking at OPEC crude oil capacity right here. And, I don't think we're going to see a tremendous amount of challenges in this area of the energy complex and in the precious metals or base metal complexes. Now, let's get back to our banking crisis, because the banking crisis, the global credit bubble banking crisis, is the crux of, so far it's estimated that over $500 billion, $550 billion, and we've got a major economist out of NYU telling us that by the time the dust settles, the major capital that will be lost just in the banking sector alone, well, we can probably throw in anyone that owns all this toxic paper that got securitized, but it's going to exceed $2 trillion of wealth. These are some of the write-offs we've taken so far with various financial institutions. And, of course, this is the basis for which they're going to have to go out and recapitalize, raise money through sovereign wealth funds and various other vehicles, where they will issue massively dilutive convertible preferred shares at high coupons that in many cases will wipe out or massively dilute common shareholders. And that's why we've seen so much pressure on the common share price. But this will get resolved. The banks will get recapitalized. I think it's you're going to see some global mergers. We're already starting to see some evidence of that already. But, hey, we've seen these crises before. We've seen bubbles before. And this is the Nasdaq bubble. I mean, this was a beautiful picture of the Nasdaq bubble, and we're no near recovery. Okay? This is the Chinese bubble today. And the Chinese bubble, which is the Shanghai Composite Index, and today it's somewhere in the vicinity of about 2,300, shows you that if you go back to fourth quarter of 2007, we've seen over a 60% decline. And I think the Chinese bubble is telling us that we have a massive global slowdown and that consumption in Western Europe, consumption in America is dramatically slowing. And I think the Chinese stock market sniffed this out, 10 months ago, and we've already seen a precipitous decline. And, there are those that believe this index is going to go all the way back to where it started, which might be somewhere in the vicinity of about 12 to 1,300 before this mess is finished. And I don't believe that's too crazy of a forecast. Now, there were those that were making that forecast up around 6,000. To even forecast it would go back to 2,000 look like a radical, massively, misinformed people. But today, that forecast doesn't look so bad. And we've seen these busts happen before. I remember I used to trade sugar back in the mid-'70s. Well, we haven't seen the price of sugar get back to its all-time peak in prices for many, many decades. Now, this is the crude oil bubble, and it burst again right here just recently, going from 147. Today it's down here in the vicinity of 108. Again, I think it's probably headed somewhere in the vicinity of $80, $85 a barrel. And then I think we're going to probably stay in a trading range for maybe a substantial period of time. Let's take a look at Southern California real estate. This is a very, very alarming chart. Now, Southern California is not the typical real estate market. I happen to live in Irvine, California. But I think this chart gives us a very interesting picture. I want you to note that we're looking at the percentage, the cumulative real change of Southern California median home prices since 1982. And let's take a look at this. This is Orange County, Los Angeles, Riverside County, San Diego, and Ventura. Now, I lived through all these crises. I've lived through every boom and every bust and every tick on this chart because I moved to Southern California in 1978. Now, I'm a 60-year-old man. That means I've lived through other real estate bubbles like the mid-70s, the one that happened in the late 80s, mid-90s, and, of course, the one that's happening today. And I've studied, historically, other real estate bubbles that go all the way back to the 1920s. So this crash, and the Online Trading Academy research team was on top of this way back in the summer of 2005. We published a lot of work on this, and along with a couple of other outspoken advocates out there. And but we've been on top of this trade, and I'll show you why. It says the cumulative real change of Southern California median prices was virtually zero to negative in the mid to late 90s. Now look in here. If you look to the mid to late 90s, right in here, now this was after the RTC crisis where we had a real estate bubble burst. And it was a precipitous decline. It was over a 40% decline. It got all the way down to, from peak to trough, down to a 60% decline. But after that, we had this bottoming process, and then we had the new bubble form, and it burst, of course, in the summer of 2005, and this is where we are today. Now, my premise in looking at this chart is the net result will be that inflation-adjusted median prices through the year 2010, or the mid-10s, will be no higher than they were 12 to 14, or 18 to 19, or 30 to 32 years before. And we've seen this, that once you come through a big bust like this, it goes through long periods of basing. And I could see this retracing all the way back, and we'll virtually have no gain in this asset class. And by the time you figure out what it costs to carry real estate in interest, taxes, insurance, and maintenance, it starts to look pretty nasty. Now, this is just nominal price change. Let's take a look at real annual price change. And this is nominal data that's actually been adjusted for the CPI, the Consumer Price Index. And if I go all the way back to the mid-'80s and I see this period of bust that followed coming out of the RTC crisis, this period of basing, the new bubble, and then another bust, we could see this thing run out all the way through the mid to late 2020s. Now, my study of real estate bubbles is that they can last long periods of time. Now, the economy is tracking this very, very nicely, and I'll show you what's driving it. We've had an investor-driven, in 2005, more than 48% of all the transactions shouldn't have been done. Okay? This was from 1973 through 2007, the expected sales based on historical sales and averages, and we were looking for this kind of curve. In fact, we got this crazy bubble. We've now reverted back to the mean, and this is annual sales volume of transactions. So we had this bubble-licious period that we were able to go through. Today, if you look at the situation today, there are more than 3.5 million excess homes that need to be filled by qualified buyers. Now, the red bars here are the excessive vacation homes, which are about 1.5 million. And then we have another excess ownership of 1.9 million. So we've got this huge excess housing inventory defined as excess vacancy plus excess ownership and we're going to revert back to the mean. And I believe we're going to see a tremendous overhang that's going to last for a long period of time. History data shows us that after long bubbles of formation, there are long periods of burst and basing. And here's what it looks like here. This is the sales activity will probably correct probably another 30% from where we are today to the 1995 level. And the 1995 level is back somewhere in the vicinity of about 4 million units, and we're up here today at about 6 million units. So we're looking for an additional correction. Now let me tell you the good news to my message. Somebody's going to live in these homes. They're going to readjust in price, and at some price, supply will meet demand, and this recession will have run its course. Because in America, and here's why it's important in America and why it's a global recession that we're going to lead, and why real estate is the big player in it, and banking liquidity. Number one, banks aren't going to come back and do subprime mortgages anymore. They got burned too much. I mean, when you lose $500 billion, some forecast it could be $2 trillion by the time the dust settles. They're not coming back. That capability to finance and fog a mirror and get a mortgage and lie on your loan documents, that era is over with. Here's the issue. It's called mortgage equity withdrawal. Now, this is compliments of PIMCO. In the blue bars here from 1996 to 2006, the government was telling us our GDP was growing at 4% per annum. But GDP without mortgage equity withdrawal is in the red bars. And without mortgage, GDP, in America, 70% of our GDP is consumption. And ladies and gentlemen, if the banks aren't going to lend freely on this asset class, if we've got this huge inventory of homes that are going to get taken off the market at a substantially lower price point, then there's going to be, Joe can't use his home to use it as an ATM to finance his conspicuous consumption and lifestyle. So I'm seeing this long period of mortgage equity withdrawal, that therefore the transactions are going to slow, the transactions in the general economy are going to slow because, again, 70% of our GDP is consumption. Now, what's this going to do for price-to-earnings ratios? Well, it's going to cause price-to-earnings ratios to revert to the mean. In essence, that's what PEs do. This is reversion beyond the mean. This is the 10-year trailing price-to-earnings ratio for the S&P 500 going from 1906 through 2007. And you can see, what is a bull market? A bull market is a period of expanding price-to-earnings ratios. What is a bear market? It's a period where we can track through the mean, and this is the average right here, all the way back to an extreme of oversold. So what we end up with are these boom-bust periods where price-to-earnings ratios expand in a bull market and contract in a bear market. And these are the averages we have to look to figure out when we're in a period of irrational exuberance or when we're in a period of irrational fear. This is the one-year trailing PE ratio for the S&P 500. That's a little bit different than the 10-year trailing PE ratio. But you can see that we are reverting now back to the mean, and it'll probably overshoot. They almost always do overshoot the average. And then the market will be in a condition of oversold, and we'll turn around and we'll have a very bullish bias at that point of time. But right now, what we're doing is selling the rallies. And yes, there will be a series of counter-trend rallies all the way to the bottom. So what should we do? Well, if this is the Dow, and if we've broken a 34-year price trend, and that's what this green line is, this red line goes back to the August of 82, and the blue line, which is really close to it, hard to see, goes back to March of 03. This has been a very significant development, and this broke on June 19th. I remember I was in London. I was giving a speech in London on that particular day. So what I'm seeing and what I'm predicting is that we're going to have a continued decline brought on by a squeeze in our global banking system. I think your ability to trade Forex is great because in times of inflation, where there's cheap liberal credit, cash is trash. But in times of deflation, cash and cash equivalent will be and have always been king. In other words, it takes less units of cash to buy the goods and services that you want. And our banking system will get recapitalized. There's going to be a tremendous price to pay. Many of our banks will lose their independence. We're already starting to see that in our investment banking sector. We're going to see more and more bank mergers. I'm looking for in excess of over 200 banks to fail in America over the next 18 months, and that may be a very, very conservative number. This NYU economist, who's forecasting $2 trillion of losses in our banking system in capital, says that over 700 banks will go out of business in America. So, one, be safe, preserve your capital. Cash is king. Cash is not always king. In times of inflation, cash is trash. In times of deflation is when cash is king. Okay? Now, I'd like to open this up to questions. I think we got about 10 minutes left. Maybe our administrator could private text me. But I'd like to answer any questions you might have. We do offer classes, by the way, on Forex trading. We also offer classes on equities trading, futures trading, and even options trading. And but I'd like to answer any questions you might have and be of service to you. So I want to thank you very much for your time. You've been a very kind audience. As a matter of fact, I have a free newsletter. If you'll email me, you can get a, let's see, Boyke wants to know, what does 3.0 mean? Globalization 3.0 means this. We're in the third era of globalization. Globalization 1.0 was from 1492 to 1800. Globalization 2.0 was from 1800 to 2000. And Globalization 3.0 means that started at the end of 2000, it's going to run out here about 100 plus years, and it's going to be when 2 billion new people come to join the free market from India, China, Eastern Europe, South America. And here's the dirty little secret of Globalization 3.0. These people are hungry, they're smart, and they're a mouse click away from cannibalizing your income. Because a lot of this work is going to get digitized and modemed off to smart, capable people across the world, and they're willing to work at a very, very affordable wage compared to what you and I are used to. I've done a lot of webinars on Globalization 3.0. Just go to my website, tradingacademy.com. On the home studies section, you'll see a bunch of recordings. I've done a ton of webinars on the subject. It's all free for you to enjoy. Okay, here's a couple of other questions. Forex versus London property market over 10 years. Which is safer? I think the London property market, there's a problem with the UK. Their toxic paper in the real estate sector, the subprime, Alt-A kind of mortgage, is like 15 times more of that paper was issued as a percent of GDP than what was issued in the United States. I'm forecasting a precipitous decline in London property prices. We're already starting to see it. I think you're far better off owning cash equivalent. Rama says, John, don't you think we have deflation in asset price, whereas inflation on commodity prices and wages? Well, we're not seeing inflation in wages in America. We're seeing deflation right now. The commodity bubble has burst. We've seen oil. We've seen the energy complex burst in price. Look at nat gas. Look at oil. We've seen gold and silver prices. Silver's gone from $22 down to $12. We've seen base metal prices like copper, zinc, lead precipitously decline. The ags are precipitously declining. Okay? It says, my presentation looks gloomy. No, I'm a trader. It's never gloomy. If we're in a bear market, I want to short. I want to make money shorting. What I want you to do is get in touch that you have a conditioned buy and hold bias, and you need to get out of your buy and hold bias. You're always coming to us and asking us, what should I buy now? Why don't you come to me and say, what looks like a good shorting opportunity today? Markets go both ways. You're right, Ed. Bad news is good news. Take advantage of it. Okay? It's not bad news if a market goes down in price if I can identify the trend and get on the right side of the trend. Okay? No, not time to buy London yet. Give London through the end of this decade. Let London clean up its banking mess. We're starting to see some banks go under in London. There's tremendous insolvency challenges in the Netherlands, in Spain. London's a mess right now in real estate. Let it get cleaned up. It will. Here's the good news to my message, folks. There's some light at the end of the tunnel. This credit crisis will get cleaned up. The central banks will work together to reinflate at the bottom of the crisis. But some of the excesses must get worked off for us to go on to the next cycle. Okay? We've been through this before. It was not the end of the world with the RTC crisis. It was not the end of the world in the mid-'70s. It wasn't even the end of the world with World War II. It looked very, very desperate in those. It wasn't the end of the world at the bottom of the Great Depression. There will be a new cycle because that's the nature of things. Why was the U.S. so easy in its credit lending? Well, it wasn't just the U.S. We led the world in the availability of cheap liberal credit. And the UK got involved in this too because everybody thought that real estate was going to go up forever. Well, obviously real estate, look, history does not support that real estate will go up forever. Okay? What do I want to short? Well, what I want to do is sell the rallies. I want to sell the rallies in Citibank. I want to sell rallies in Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are going to get nationalized. The common shareholders and unsecured debenture holders are probably going to get wiped out. So I want to short the rallies. I want to short the rallies in the home builders. Okay? How will I know that the home building mess is over? They still got too much inventory. We got 3.5 million properties in America that have to get worked off. Now, there will be rallies. None of these markets go straight down. Now, what we teach you in Online Trading Academy is don't try to catch the falling knife. All of you want to buy something. You always want to, what we want to teach you to do is wait for the high probability counter trend rally that comes in a secular bear market and short sell the high probability counter trend rally. Long-term, London always been trumps. London, I'm sure, will do fine long-term. But right now, we're going to have a correction. Let's take advantage of that. Don't you wish you would have shorted the home builders in the UK a year ago? In summary, thank you very much. I hope you'll visit Online Trading Academy. We got 30 centers around the world to serve you. God bless you all. Good luck.